Okay, now we will continue with the concept of valuation of debt and preference shares. Type of finance, preference shares. If preference share is irredeemable, then price is equal to D naught divided by cost of preference share. If it is loan notes and irredeemable loan notes, these are called what? These are called market value is equal to interest divided by cost of debt. Then we have irredeemable debt. Market value is equal to interest divided by cost of debt. And cost of debt is usually after tax. Redeemable debt. Present value is of the future interest plus this future interest is present value of the future interest what we will earn, and this present value is determined at post tax KD, and redemption receipts future discounted at investors required returns. D naught is representing current preference dividend. Price means X dividend. Remember, we always use excluding dividend price. Here we have a question: a firm has an issue of 12% preference share with a nominal value of 1. So first of all, calculate dividend per share. Nominal value into dividend percentage, it is 0.12. Currently, the required rate of preference share is 14%. 0.12 divided by 0.14. Market value is 0.85. Point 85. A company has an irredeemable loan note with a coupon rate of 7%. When par value is not provided, it means it is 100 into $0.07. Required rate of return is 4%. 7 divided by 0.04. It is 175. A company has an issue of 9% redeemable debt with 10 years to redemption. Redemption will be at a nominal value, which is $100. Investors' required rate of return is 16%. It means first calculate interest per year is equal to 100 into 9%, which is $9. Now we will calculate annuity value at 16%, which is required rate of return. 9 multiplied by annuity factor at 16% for 10 years. Then present value at 16% of the redemption value, which is $100. So if any one of you can look at the present value table and share the present value factors or annuity factors. Or I have to check. So now we will calculate annuity value 9 into 833, 43.497 22.7, 66.197. Now we have convertible, where we have the option of conversion of loan notes into ordinary shares. Our company has an issue of convertible loan notes with a coupon rate of 12%. Each is $100. Loan note may be converted into 20 shares at any time until the date of expiry, and remaining loan notes will be redeemed at $100. Loan notes have 5 years left to run. Investors would normally rate of required rate of return at 8% for 5-year debt security. Should the investor convert if the current share price is 4, 5, or 6? So we have to value at the different levels. 5 years remains. First, we will calculate floor value. Floor value means he will earn interest of 12% minimum for next 5 years. At what? At 8% cost of capital. So at 8%, 5 years annuity factor is 3.993. And after that, he will earn $100 as redemption value after 5 years at 8%. Present value factor of 0.681. So 12 into 3.993, 47.916 and 68.1. 116.016. This is floor value. Now he has different options that at what price it will be beneficial. Definitely at more than this value. First of all, we will calculate conversion value, where 20 shares are multiplied by, if I assume that at $6 highest value, so 120. Now annuity value of interest will be same, either I go for a redemption or to go for conversion, but conversion value is multiplied by a present value factor 120.681 plus 47.916. So here I have 129.636. At this price, I will definitely prefer conversion because I can earn conversion premium of 129.636 minus 116.016. 13.62. If I look at 5, that if share price is 5, then 5 into 200 at 5 it will be equal. So at 6 it is beneficial. In the next case, he says that calculate these values. 8% bond issues, $100 nominal value, 3 years time, 30 is the ordinary share conversion, current is 3.3, and the 5% growth rate, required rate. There are 3 options. First is called market value. To calculate market value, first of all, we need conversion value, where we are converting in our loan note into shares. 30 into 3.3 into 1 plus growth rate raised to power 3. 30 into 3.3. So the conversion value is 114.60. Now calculate annuity value of interest. 100 into 8%, $8 into 6%, 3 years annuity. 2.673. This is annuity value of interest plus present value of conversion value. So now we will use 3 years present value factor at 8%. Sorry, at 6%. So present value factor at 6% for 3 years. 0.840. 114.6 into 0.840, it is 96.264. So we will add up these two values. 117.648 is the market value. Floor value is annuity value of interest plus present value of this par value, which is redeemable at 100. Redeemable at 100. So 100 into 0.841, 840, 84 plus 21.384, 105.384. This is floor value. Conversion premium is what? 117.648 minus 105.384. 12.264. So this is the value of convertibles. Next one is market efficiency. What is the concept of market efficiency or efficient market hypothesis? Efficient market hypothesis basically says whenever there will be a news in the stock market, it will affect the share prices. Now it says that there are three different types of efficient market hypothesis. First one is called weak form of efficiency. Weak form of efficiency is the one where we are looking at the movement of share price which is based on past information. So it says that weak form of efficiency is not the trustworthy, or share prices in the weak form of efficiency stock market are not trustworthy, not reflecting the true share price. Another factor is what? Another factor is weak form of efficiency is also called inefficient market. On the other hand, there is also there is a market which is called semi-strong form of market. Semi-strong form of market is the one where share prices are representing the recent away information, where change in the share price will arise within 3 to 5 minutes time. So this is called what? This is called semi-strong form of market. In this market, share prices are reflecting the fully available public information. But in this market, we can earn abnormal profit if we have any insider information, because all the insider information are not easily available publicly. Next one is semi-strong form of market. Semi-strong form of market is the one where, strong form of market, where there will be no private information. All information is published by the company and all information is easily available for the public. So this is called what? This is called a strong form of efficiency. In this market, no one can earn the abnormal profit. So these are called what? These are called different types of efficiencies. Remember, weak form of efficiency is alternatively known as what? Inefficient form of market. Semi-strong market is also known as weak efficient form of market, and the strong can be known as semi-strong form of efficient. Basically, it is not possible to have efficiency, strong efficiency, because it is not possible that all information will be public by the organization. There is always insider information or private information. Next one is called behavioral finance. Behavioral finance means a few people are basically emotional or sentimental and they cannot make decision on the basis of rationality. They make decision on the basis of the market or on the basis of others' responses. Basically, their decisions are called irrational decisions. Behavioral finance is based on a few elements. First one is called herding. Herding means what? Herding means we are choose to buy or sell particular shares because many other investors have already done so. This is called what? This is called herding. We herd from others. Stock market bubbles, when we are following herding, it means there will be increase in share prices significantly and index will rise. This is called stock market bubble. And at a certain time, this bubble will become or will what would I say that this bubble will not maintain its position and there will be uh, fall in the share prices after the burst of this bubble. Then he says that noise traders, a few traders are the one who create noise in the market. Due to their noise, a few investors will be convinced to make investment or will be convinced to sell investment. Loss aversion, where investors avoid investment that have the risk of making loss, even though long-term analysis would suggest significant capital gain. Momentum effect is what? Once a trend is seen in the share price, the market may become opposite or pessimistic, and this will stimulate or stifle further investment and lead to the trend continuing. So this is called what? This is called behavioral finance. Practical considerations in the valuation of shares and business marketability and liquidity of shares, which means either these shares are easily saleable in the market and convertible into cash or not. Either available information is the correct information or incorrect information. Equilibrium price means the price is in relation with the supply and demand. It is not more than the expectation and as well as it is not less than the expected price. So this whole is called what? This whole is called business valuation. We are done with this chapter as well. Now the final topic is Forex and interest rate risk management, which we will discuss in the next class. If you have any question, you can ask me. Otherwise, session is ended.